Hey everybody, it's Craig Moser. It is the 15th day of June, 2021. We're almost halfway through the year. Kind of crazy, I know. Wanted to share some information with you, just kind of take a brief look at the markets and then come up with a couple of ideas maybe as we go into the second half of the year to get you to think about. So let's talk a little bit about obviously the markets. I do the charts, and some people hate them, some people like them. Sorry about that. But wanted to look at, well, what I have up here first and foremost is a 2-year chart, daily chart of gold. Now we're using the Spiders Gold Trust, the gold shares, but it mimics, if you move the decimal over, it mimics the price of gold. So as you can see, gold over the last 2 years made a fairly significant run. It culminated right there around the 1st of August last year. And since then, it's been struggling to make new highs. So, you know, I hear a lot about gold all the time. People are conscious of it, want to own it. But just understand that it's an asset that pays no dividend, earns no income. So really it's just what somebody else will pay you for it. So just keep that in mind. As we look at the S&P 500, which is sort of the bellwether for everybody, when they look at the market, they always think of the S&P. When you look at this market, you can see that, and again, we're looking at 2 years, that if you drew a line from point to point, what you would see is a pretty interesting chart. What's happening is we have had a big thrust up. It has been pretty much on that trajectory right there for 2 years. You know, we had COVID in the middle of it, which kind of messed it up a little bit, but we had a very robust economy before, if you stop and think about it. We had very low unemployment. We were making jobs, taxes were in control, and things were going pretty good. So this is a follow through, I would suppose, on that, with the caveat that we printed a whole bunch of money. I mean, like a whole bunch of money. So just be conscious of the fact that this is not a organic growth model that you're looking at. This is not a normal world. We have a lot of weird stuff going on right now, especially trying to recover back from this virus where the government did, I will not say unprecedented stimulus, but they certainly have stepped up the stimulus game to keep everybody with a paycheck. So that's kind of where we are with that. The NASDAQ is a different animal. And I want to take this back to a 1-year chart real quick. On the S&P, we're still seeing mostly an upward trajectory over the last 1 year. So that's a pretty nice looking chart. But if we take the NASDAQ, let me just click it down here. Different story. So what's happening here? The NASDAQ ran up right here. That was about September 1 of last year, leveled off, ran up, and now we're starting to see another leveling off. So the question that you need to ask yourself is this: with prices as high as they are on stocks, can they go higher? Because, you know, right now, you know, you still want to hit the home run, perhaps, if you're trading and doing the Robinhood thing. But if markets are kind of topping out, do we need to think a different way? And so that's something that I'm just sort of planting a seed in there for you to say, okay, if these high growth ideas have kind of grown to the point to where they may not have a whole lot of upside left in them, where do we put our money? So when you look at things like, and I'm going to use dividend growth as an example. This is an ETF, but the strategy is to buy stocks that are healthy enough to raise their dividends every single year. And they've done it for a long, long time. So, you know, you can see, although this has been a great chart pattern, we're starting to roll over a little bit. So just trying to say that stocks may have sort of found a resting point here where we're starting to churn up and down, finding it a little more difficult to make headway, those types of things. A real popular investor is a lady by the name of Kathy Woods. So Kathy is a person that invests. She has a program called ARC Innovation. This is sort of her bellwether fund. There's several, but this is her bellwether fund. And what happens here with that is we had a great run up, and then it kind of just sort of melted away. So what does that mean? That means that these types of companies that are disruptor companies have sort of made their run for a while. Now she's still accumulating, she's still buying good companies that she thinks will be the future of technology especially, but just be aware that, you know, when you make a high and then a lower high, this high needs to exceed this pattern right here, or something's going on with these types of ideas. In here would be companies like Tesla, which is a great company, but, you know, again, struggling at this point because competition's starting to show up. It's interesting to watch how this is working. Bonds. Now, usually I just do the chart, but let's talk a little bit about the yield. So here's a 1 year on the bond market. This is a way to buy what used to be the Lehman Brothers bond aggregate. It's now the Barclays bond aggregate, and iShares gives you a way to buy that aggregate. So you can see right here is its 200-day moving average, and the prices of the bonds are below that average range, and that's starting to roll over as well. The yield. So right now it says the bond aggregate, which is sort of the proxy for the whole bond market, is a smidge under 2%. So if you buy this over the course of 1 year, it should pay you 1.99%. That's not a whole lot of money, you know, especially with something, when you're looking at that chart, you have to admit it does have some volatility if you're looking over the last 2 years. So I don't know that that's a real strong place to be, and it's hard to find income off of your investments these days. And this has been a place that we have gone for the last 30 years to get yield, I guess, and the bond market's pretty low interest rates right now. I'd already done gold. Let's look overseas. Now, here's a little bit of an interesting thing. Europe, Australia, and the Far East, the EFI index is has been behind us for 5 years. Let me give you a comparison. So I'm going to do 5 years with the EFI, and you can see it's sort of been a struggle. Get some of this stuff off of here. And let's do a compare of the S&P 500 just to give you an example. So the US has significantly outgrown Europe, Australia, and the Far East over the last 5 years. It was a horse race until right here, and that was about 2018, I believe. Yep, about January of 2018, and the market sort of topped. And then from there, we've pretty much pulled away from developed Europe, Australia, some Canada in there, some things like that, but we've pulled away. But their growth trajectory is starting to pick up some. That's really what I wanted you to see, is that we're starting to see some growth in that area. And then the emerging market space, that houses, China is the biggest player in there, and you're seeing a consolidation pattern like I showed you for our NASDAQ. We had a nice run up, and now, can I meet and exceed the last top that we had, which was really in February? So just understand that things are getting a little tired, is the way I want to say it, and just be a little more cautious that stepping up to the plate and trying to hit a home run, there's not as many of those out there as there were a year ago when the markets declined substantially. So there's nothing wrong with taking small profits, taking some off of the top, if you will. And if you see an opportunity, meaning that the market were to decline enough, 10, 12%, maybe taking a, a little bit of time to say, here's a list of things that I'd like to own, and understand what the prices perhaps would be that you'd like to buy back in on those. Okay, that's all I have for you for this month. If you need to get in touch with us, our number is 336-448-1086, or you can visit us on maestrowealth.com. Be happy to share any information that we have. Make it a great month.